Hey guys, so this week the big banks are poised to release their fourth quarter earnings. For S&P 500 earnings overall, investors are still bracing to see the corporate profits fall in fourth quarter over the prior year, extending 2020's streak of weak earnings as the coronavirus pandemic sapped up demand and disrupted operations across numerous industries. And analysts expect to see an aggregate S&P 500 earnings per share decline 8.8% year over year in the fourth quarter, which would represent the third largest year-to-year drop in earnings for the index since the third quarter of 2009. However, this estimate has been updated because of the upward mobility that we've been seeing in the first part of January. There's an improving outlook for profits in the financial companies contributing to the most of these improvements. And one of these analysts has been quoted to say that the financial sector has recorded the largest decrease in its expected earnings decline of all 11 sectors since the start of the quarter. This sector, which is the banking sector, has also witnessed the second largest increase in price of all 11 sectors since September 30th. So some of the biggest banks include JPMorgan Chase, Citigroup, and Wells Fargo. Everyone's eager to see what kind of results their fourth quarter earnings are going to bring to the stock market. Shares of some of the biggest US banks got a boost in the final leg of 2020 as optimism over a vaccine and economic reopening eased fears of the widespread customer defaults and offered prospects of affirming rates. Last year's low rate environment, with the Federal Reserve still maintaining benchmarks interest rates near zero, had dragged on banks' net interest income and profits made for their core lending businesses to resume buying back shares and paying dividends so long as they total less than the average of their net income over the previous year. Earlier in 2020, the Fed had capped big banks from increasing their dividends or conducting any buybacks through the year end to ensure that they would have enough capital shored up to buffer against possible swift downturn in the economy. Banks had also begun releasing some of their massive credit loss reserves last quarter, which had swollen to compromise tens of billions of dollars at the height of the pandemic in anticipation that more loans would soar and worsen the economy. These substantial provisions for credit losses also had anchored bank profitability earlier in 2020. And while banks' lending business likely firmed in the fourth quarter, trading revenue likely extended a run of strength as a still surging stock market helped boost activity across the businesses. JPMorgan's fixed income market and equity markets revenue had jumped 29% and 32% respectively in the third quarter, while Citi's revenue in these categories grew by a respective 18% and 15%. So against the improving earnings backdrop for banks, strategists increased their outlook for financials for 2021 after the sector ended 2020 as the third worst performing after real estate and energy. That's good news to a lot of investors that are currently holding big banks as investments. And I think that's also good news overall as the economy continues to bounce back from 2020. So that's all I have for you guys today. I hope this brought some insight. If you have invested in banks or are thinking about investing in large banks, I hope this information is valuable to you. And if you haven't subscribed, please consider subscribing. I'm trying to get to 200 subscribers in the next couple months, so your support would be greatly appreciated. And make sure to like this video if you would like to see more content like this. And we'll see you on the next one.